Okay, let's dive right in. Picture this. There's this team, right? And every single morning before the market even opens, they've basically run through over 500 different ways the day could play out.
Hmm.
And we're not talking about just, random guesses. These are intense, data-packed simulations, like serious stress tests asking what if.
Yeah, that image, it really grabs you. It's right there in the sources we're looking at today. And it gets the absolute core of what Ken Griffin built at Citadel.
Exactly. It seems to be the engine behind how he took market volatility, something most people run from, and turned it into this, well, frankly, staggering fortune. We're talking $44.3 billion.
And it's why, as material suggests, a lot of Wall Street seems to be playing catch-up. They're reacting, while Citadel, because of this process, might already be positioned. They've sort of rehearsed the chaos already.
It's that preparation level that just jumps out, isn't it? The sheer intensity of it.
It really does. It goes way beyond typical risk management. It's more like this proactive, almost obsessive foresight.
And it's not new for him, right? The sources trace this back.
Oh, absolutely. Right back to his earliest days. Even that famous story from his Harvard dorm room, installing a satellite dish on the roof, just to get market data faster.
Yeah, I remember reading that. Seconds mattered, even then.
Exactly. That detail, it really highlights this relentless focus on information on speed right from the very start. And look where it led, that dorm room setup. Now it's Citadel, managing what, over $65 billion in assets as of February this year, 2025.
And that personal wealth figure you mentioned, $44.3 billion. Forbes, June 15th, 2025. Very specific. It's not just some huge number on a list, is it?
Yeah, not at all.
Our mission here really is to get behind that number. How did he actually build that? We want to peel back the layers, look at the discipline, that system of running hundreds of scenarios every day, the whole philosophy behind controlling risk.
It's like looking at the blueprints of this financial machine, one designed specifically for a world you just can't predict.
So that's what we're doing today. We'll break down what that $44.3 billion really signifies.
Right. Go deep into what running 500-plus scenarios a day actually looks like, how it gives them that edge.
We'll look at the culture inside Citadel, that daily grind of discipline.
Yeah, and Griffin's own thinking about chaos and uncertainty, which is pretty interesting, kind of counterintuitive.
And finally, how he fits into the bigger picture, his influence, his strategic place in global finance.
Sounds like a plan.
Okay, let's start with the number itself. $44.3 billion, as you said, Forbes, June 15, 2025. It puts him way up there, hashtag 32 globally at that point.
Yeah, and think about who else is in that league. Tech founders, maybe some crypto folks, oil money. He's right there with them, sometimes ahead. And the sources stress this isn't some vague estimate, it's reported.
And crucially, how it was built. The sources are clear. This wasn't one lucky break, like an IPO hitting just right or a viral app.
No, it was, as one source puts it so well, built battle by battle. Over almost 4 decades. Think about that time frame. 40 years.
Wow, day in, day out.
Incredibly competitive markets.
Yeah.
From that Harvard dorm, chasing tiny price differences with faster data.
To managing $65 billion today.
Right. And every bit of that fortune is framed as a byproduct, a result of intense research, cold logic, and, here's that phrase again, an almost obsessive dedication to risk control.
Obsessive dedication. That really sticks. It suggests risk isn't just something on a checklist, it's the central focus.
It seems so. And you see this play out through major market crises. 2008 is the big one, the stark example.
They weren't immune, were they? The sources say they got hit hard.
Oh, yeah. Lost over 55% of their value. That's a potentially fun-killing number. Devastating.
Existential, even.
Absolutely. For many firms, it was. But Citadel's story diverges here. The sources point to the recovery, the speed, the scale of it.
What was it? By end of 2009?
A stunning plus 62% return. And the material insists this wasn't just luck or riding the market back up. It was a direct consequence of 2008.
Learning from the crisis.
Totally. Griffin didn't just survive it. He used it. Rebuilt liquidity systems, fundamentally made sure they wouldn't get caught short again. And crucially, doubled down on the stress testing, on the scenario analysis. The sources say the vow was never be that vulnerable again.
So that failure, that pain, became the foundation for something stronger.
Exactly. Bedrock for a much more resilient system.
And you really see the payoff when the next huge unforeseen crisis hits. COVID in 2020, the market tanks.
Right. S&P 500 drops 12% in March 2020 alone. Chaos everywhere.
But Citadel's main fund.
Actually up 1.2% that same month and finished the whole crazy year up 5.7%.
Incredible contrast.
And is presented as proof of concept. The system forged after '08 worked. The sources say no guesswork, no panic. While everyone else was reeling, Citadel was executing with surgical precision.
Because they'd already simulated extreme shocks?
That's the argument. It wasn't intuition in the moment, it was the system kicking in. They'd run scenarios that included pandemics, shutdowns. It allowed them to spot risks early, execute plans they already had. The process proved itself under completely different but equally extreme circumstances.
And fast forward a bit. By 2023, Citadel's footprint is even bigger. It's not just fun performance-making news.
No, you start seeing headlines about record real estate deals, that huge personal wealth being deployed very visibly. Plus, growing political influence. And the quiet giant, Citadel Securities, the market-making arm, hugely profitable but mostly behind the curtain for everyday investors.
So the empire grew diversified.
Significantly. But, and this is critical, the sources tie it all back. Through all that expansion, Griffin apparently never lost sight of that core principle: discipline, preparation.
There's that quote from him, right, from 2022.
Yeah, sums it up perfectly. We don't assume the future will look like the past. That's why we run more than 500 market scenarios every single day.
That really says it all. So when you look at that $44.3 billion now,
You have to see the engine underneath. The sources push you to see the thousands of hours in data labs, the hundreds of scenarios modeled daily,
it's not passive wealth. It's the outcome of preparing for chaos.
and being positioned not just to survive it, but, as the sources explicitly say, to profit from it. It reframes the whole idea of financial success.
Less about luck, more about process. A very demanding process.
Exactly. Which brings us squarely to that process itself, running 500-plus scenarios daily. What does that actually involve? Sounds almost futuristic.
Yeah, like something out of a movie.
But the sources break it down. These aren't just random what-ifs. They're called rigorous, data-driven stress tests. Think simulations, carefully built, exploring a massive range of possibilities for the markets before the day even starts.
Built on data, history, models, but pushing beyond the obvious.
Right. They're designed to explore the edges, the less probable but still possible futures.
And the kinds of things they model. It's a wide net, isn't it?
It is. The sources give examples. Sudden big interest rate hikes from the Fed, oil price spikes due to geopolitics, supply chain meltdowns, geopolitical conflicts escalating, even major cyber attacks on market systems.
Wow. And they also mention black swan events, things that haven't happened before.
Exactly. Those highly unlikely, potentially catastrophic events. They're trying to model the unknown unknowns, or at least the things way out on the tail of the probability curve. It's not just about known risks.
And this isn't just some research team off in a corner, right? The sources say this scenario engine is the backbone of their daily operation.
Absolutely central, not a side gig. The output feeds directly into the firm's daily workflow, and the scale is huge.
Oh, huge.
These tests run across thousands of individual positions they hold, across dozens of different strategies, equities, credit, commodities, quant stuff, supporting over 100 portfolio teams globally.
Okay, so the goal is very practical then. Identify weaknesses.
Precisely. Pinpoint exactly which positions are vulnerable under which specific conditions across the whole book.
And then they act. There was that example, scenario, hashtag 187.
Yeah, it illustrates it perfectly. Let's say scenario hashtag 187 flags a risk. A combo of a big Fed rate hike and weak European export data hits their high-yield bonds hard.
Okay.
The sources say the response is immediate. They move, no hesitation. The risk gets hedged, maybe trimmed, maybe eliminated entirely. The action follows the simulation result. No second-guessing based on gut feelings.
That pre-calculated response, that sounds like the unique edge the sources talk about.
It really seems to be. They contrast it directly with most other funds. Many do some risk modeling, sure, but daily across everything, and hundreds of tailored scenarios every single morning. The sources say almost nobody does that.
So they're not just reacting.
They're rehearsing. That's the analogy the sources use. They've already seen in simulation how things could break, which lets them plan responses way ahead of time.
And we saw the results. 2023, the Fed hikes caught many off guard. Citadel's Wellington Fund.
Up 15.3%, way ahead of the average. The sources attribute it not to perfect prediction, but to that rehearsal. They'd run countless scenarios involving rapid tightening.
And this system keeps evolving. Mention AI.
Yeah. Looking towards 2025 and beyond, they're integrating AI to spot new kinds of tail risks. Things like flash crashes from rogue algorithms or maybe shocks from cloud failures. always looking for the next potential threat to simulate.
It all comes back to that mindset, doesn't it? Designed for chaos before chaos arrives.
Exactly. And that quote about luck.
Luck is just what happens to people who didn't run enough scenarios.
It's a stark way to put it. It basically says what looks like luck from the outside navigating a crisis perfectly might just be the result of having simulated that exact, maybe improbable scenario and having a plan ready. Preparation equals opportunity.
So let's connect the dots. How does this intense daily process translate into a sustained edge over Wall Street year after year?
Well, the sources paint Citadel as operating on a different plane almost. Like it's from the future, one says. Because that daily simulation engine lets them anticipate deeper, not just react faster.
Seeing how things break before they break.
Kind of. Understanding the hidden connections, the potential cascade effects, the weak points in the system that only become obvious during a crisis, it builds what the sources call strategic foresight.
Let's revisit those crises again through this lens. 2008, they still got hit hard initially.
Right. That 55% law shows no system is completely foolproof against something that massive and systemic. But the key was the rebound. That plus 62% in 2009 is framed as the reset year.
What did they reset?
The crisis gave them invaluable data on how their existing system failed. It proved the need to go even further with risk engineering, make the scenario engine more robust, build deeper liquidity buffers. The edge wasn't avoiding the pain, but being built to analyze, adapt, and rebound faster and stronger than anyone else.
Okay, and then 2020, the COVID crash. The S&P down 12%, Citadel up 1.2% in March.
That's the system working as intended. They'd rehearse shocks like pandemics, shutdowns. So when it happened, it was no guessing, no gambling, just disciplined scenario execution. While others panicked, they were running plays they'd practiced.
And 2022, the meme stock frenzy, that was different again.
Very different. And Citadel Securities, the market maker, was right in the middle. Remember, a market maker provides liquidity, buying when others sell, selling when others buy.
So they were handling a lot of that crazy volume.
Exactly.
Yep.
They were able both to provide that essential liquidity and profit from the extreme volatility in volume. The sources mentioned Citadel reporting over $16 billion in profit that year, a staggering number. It showed how their structural position, combined with volatility management, could turn chaos into huge returns.
And this whole system, it's not just about Griffin himself. The sources say it's unbeatable because it's institutionalized.
That's a really important point. It doesn't depend on one person's gut feeling. The risk engine, the scenario framework, it's embedded into the daily workflow. Every team, every manager uses it. Capital deployment decisions get filtered through hundreds of simulated outcomes first. It's baked into the firm's DNA.
Which brings us to now 2025. Geopolitical tension, AI worries, central bank uncertainty. How does this help them today?
The sources suggest that while others feel whipsawed, asking what now, the Citadel remains calm, focused, unshaken. Why? They've likely already run scenarios involving these exact issues.
So while others react.
They might be, as the source puts it, already on scenario #348, adjusting, preparing, and positioning to win, based on those simulations. They're less likely to be surprised because they've already explored so many possibilities.
It's clear that just having the tech or the capital isn't the whole story. There's something else, an invisible force, the sources call it.
And that force is identified as daily discipline. It's not occasional. It's a systematized institutional culture of precision that operates 204/7. Griffin didn't just buy algorithms, he built expectations.
What kind of expectations?
Data. Decisions have to be backed by data, period. Execution has to align with the scenario analysis. And apparently, zero tolerance for complacency.
How do they enforce that?
Real-time performance measurement, not just quarterly reviews. If a strategy underperforms or shows unexpected risk, it gets looked at immediately, often that week. If managers breach risk limits set by the scenarios, the sources say they're replaced, doesn't matter how smart they are. Process and risk control are paramount.
Sounds incredibly high pressure.
It must be. And the sources link it directly to Griffin's own intensity. Wakes up early, reviews dashboards instantly, expects meetings to be punctual, data-driven, action-oriented, no room for fluff or guesswork.
There was that quote from a former employee.
Yeah, capturing the mental load. Like playing chess, poker, and math Olympiad at the same time every day.
Chess for strategy, poker for risk, math for the sheer analysis. Wow.
It takes a specific kind of mind, blending all those skills. And the results seem to follow. The sources cite internal estimates, Bloomberg reports. Top teams beating 90% of peers consistently over 5-year cycles. They call it engineered dominance, not just good returns.
Even the office layout reflects this.
And apparently so. Risk teams sit right next to traders. Developers sit with strategists. Everyone sees the same dashboards in real time. Griffin calls it radical transparency, but the sources suggest operational alignment might be more accurate. Everyone's focused on the same data, the same potential risks flagged by the scenarios.
It all feeds into that daily loop, doesn't it?
That's the heartbeat of the place. Run scenarios, absorb results, adjust positions based on risks opportunities, test assumptions, act decisively based on the pre-planned scenario responses. Do it again and again. While others debate narratives, Citadel acts on probabilities from their simulations.
So the real edge isn't just the money or the tech.
The sources conclude it's the culture. A culture engineered around daily discipline where performance isn't just rewarded, it's required. It's the human system, structured by intense process.
Which leads us to Griffin's core philosophy, his whole mindset about uncertainty itself. It sounds like he doesn't just deal with volatility, he kind of expects it, builds for it.
That's exactly the takeaway. He doesn't fear uncertainty. While most people want stable, predictable markets, he accepts volatility as inevitable and even useful.
Useful. How so?
The idea seems to be that chaos isn't the enemy, it's the environment. Markets are messy, sure, but that mess contains signals, opportunities, if you have the right framework to see them.
And that quote again, we don't assume the future will look like the past. That seems key here.
Absolutely fundamental. It means history is useful, provides context, but it's not a guaranteed map. Things change tech, geopolitics. So models have to adapt. Assumptions need constant stress testing. Ideas have to survive contact with reality, meaning they need to hold up when unexpected things happen.
So the scenario planning isn't just about past crises, it's about things we haven't seen.
Precisely. They explicitly prepare for edge cases, those really rare events most funds ignore. Weird commodity shocks, new kinds of credit problems. The scenario engine becomes almost a belief system, constantly reminding everyone to expect the unexpected, never trust calm markets. Calm often precedes storms.
And this mindset helps explain why they seem to navigate disruptions so well.
It connects the dots. 2008, 2020, the meme stocks, the current AI-driven volatility. In each case, they weren't scrambling. They were often positioned, having already explored scenarios involving that kind of chaos.
It sounds like it's about hard preparation over just hoping for the best.
Exactly. Griffin believes markets reward preparation, and his version is demanding. Mathematical, scenario-based, and uncomfortable. It forces you to challenge your own biases, confront potentially nasty outcomes.
Is there room for debate inside Citadel, or is it all just follow the models?
Debate is encouraged, the sources say, but with a big caveat. It must be backed by data. No gut feelings allowed without proof. They want contrarians with spreadsheets, people who challenge ideas but use numbers to do it.
And you have to be willing to drop your idea if the data changes.
Without ego, is the phrase used. Because, as the sources state, in fast markets, ideology is a liability, and adaptability is the only hedge that works. Sticking to a belief when data says otherwise is dangerous. The goal isn't perfect prediction, it's being structurally ready for any version of it, assuming chaos is always possible.
Moving beyond the trading itself, Griffin has also built this significant presence, this influence across finance and even politics.
He really has. And the sources suggest he does it systematically, building systems and structural positions, not just chasing headlines.
Citadel Securities, the market maker, seems absolutely central to that.
It's described as a core pillar, one of the biggest market makers anywhere, handling, as we mentioned, over 40% of U.S. retail stock trades by early 2025. Think about that. If you, the listener, trade on an app, odds are very high. Citadel Securities is facilitating your trade.
That gives them that structural seat at the center of market liquidity, as the sources put it, part of the market's basic plumbing.
Exactly. And that position provides unique data and insight. But his influence goes further. He's a massive political donor, over $1.5 billion given over the decades to various causes, political, educational.
And that very public spat with Harvard in 2024 pulling his funding, that showed his influence wasn't just financial.
Right. It showed his willingness to weigh in on ideological grounds, and that institutions really take notice when someone with his clout makes a move like that. It caused a huge stir.
You also see his reach in huge real estate deals, funding science and tech education.
The sources paint a picture of him positioning himself strategically across multiple fields. A gatekeeper via Citadel Securities, a builder via investments and philanthropy. But, as the sources note, his power often feels more quiet, systemic, and deeply entrenched, compared to some other billionaires.
And because Citadel is so central to how markets work, his voice matters in regulatory debates.
Immensely. Issues like high-frequency trading rules, market structure. His firm's operational reality gives their perspective huge weight, beyond just lobbying.
And splitting the business, Citadel for investing, Citadel Securities for market making, that was strategic too.
The sources frame it as smart architecture. Reduces regulatory overlap, diversifies revenue, increases flexibility. A calculated design choice.
So in a world where players come and go, he's built something aiming for permanence.
That's the word the sources use, permanent. While others chase trends, he's built infrastructure, architecture. That's fundamental to the market itself.
Which leads to that final thought in the sources about what real power in finance looks like today.
It's not just wealth or being visible for a moment. It's building that enduring architecture, achieving permanence within the system. And Griffin, the sources argue, gets that completely.
Okay, let's try to wrap this up. If we pull all these threads together, the sources paint a really consistent picture, that $44.3 billion. It's not luck. It's the outcome of this incredibly disciplined, system-driven approach at Citadel.
Right. They don't win by predicting the future perfectly. They win by being ready for almost any potential future the market throws at them. While others are guessing or reacting, Citadel has likely already simulated it and is executing a rehearsed plan.
So if we boil down the key lessons from these sources.
Well, first, markets reward preparation, deep preparation, not just optimism. Hope isn't a strategy.
Second, success isn't about never being wrong. It's about resilience building systems so that surprises don't kill you.
Third, true discipline isn't rigid rules. It's constant adaptation based on new data, new risks, always learning, always adjusting.
And finally, you thrive in chaos not by hoping it goes away, but by modeling it, training for it every single day.
And the sources make that point. There's no fixed map for the future, which could sound scary.
But the takeaway isn't helplessness, is it? It's the opposite.
Exactly. It's about agency. It highlights that you, the listener, can actually apply these principles, maybe not running 500 market scenarios, but the core ideas.
Thinking about different outcomes, understanding risks, being disciplined. You can apply that anywhere. Investing, career, life.
Precisely. Building your own resilience, your own way of navigating uncertainty, so you're ready to adapt and maybe even thrive, whatever scenario comes next.
That's a really powerful thought to end on, building your own architecture for uncertainty.
It is.
Well, this has been an absolutely fascinating look into Ken Griffin, Citadel, and the power of that relentless preparation, all based on the material we had today. Thanks for joining us for this deep dive.
My pleasure. Always great to unpack this kind of stuff.
We hope you, the listener, take away some valuable insights about preparation, discipline, and maybe even seeing uncertainty a little differently. Until next time on The Deep Dive, take care.